The general business plan is to go and do our value add right away, take the property offline or half of it offline at a time, go and completely renovate it inside and out. And then after we have 12 full months of financials, so, with renovation, it'll probably take about 17 months to get a full 12-month P&L to show a bank, and then refinance and pull all of our capital back, return all the capital, and then sell in year 3 or 5. And our investors can see a 2.5x to 3x equity multiple.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Shawn Dimartile and his partners are multifamily syndicators, boutique hotel operators, and short-term rental investors. He and his partners have over $52 million in assets under management, and they're also hosts of the Multifamily Takeoff podcast and host their own real estate meetup in San Diego. Shawn, welcome to the show.
Thank you so much for having me on, Sam. I'm stoked.
Hey, man, pleasure's mine. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Where'd you start? Where are you now? How'd you get there?
All right, in 90 seconds or less. Where I started as an air traffic controller for the FAA. That was my W-2 job before I quit in March. I met my 2 partners in air traffic control. We were all interested in real estate investing, and we jumped right in by liquidating our 401ks, taking our saved money, and buying a 32-unit apartment complex. We started our own podcast as well. We call it the Multifamily Takeoff, and that's just kind of a play on words since we were all air traffic controllers. Right. Fast forward, and we got some mentors, and we started growing over the past year, especially exponentially. Did 2 big syndications last year. Right now, we're sitting at 300 multifamily units. We have our own portfolios of numerous Airbnbs, single family, and we've started purchasing boutique hotels. We closed on the first one on Monday.
Man, that's a lot of moving pieces. I love that. And so it was just March here of 2022 when you waved goodbye to being an air traffic controller.
That's right. And that was it's a scary thing for anybody to do, no matter how many assets you have, to quit that guaranteed income W-2. And it was a really good job, high 6-figure income.
Right.
So, to walk away from that was definitely monumental, but it's definitely allowed me to focus on this real estate more, raising capital and putting all my energy into this.
Yeah, I mean, and for people that don't know, air traffic controllers, I mean, that like you said, it's a very nice paying job. I mean, those are hard things to walk away from. Where'd you work out of?
So I worked out of there's a facility here in San Diego, and it's a radar only facility called SoCal TradeCon, and I control the approaches and departures for Long Beach Airport, Fullerton, Los Alamitos, and Torrance, and I did that for 6 years.
Wow. That's in some of the busiest airspace in the world.
Exactly.
There you are coordinating all those flights. Man, I bet your stress level has gone down just slightly.
Absolutely. And you're working crazy hours in that job, like all shifts. I would work morning, night, and graveyard shift in a 5-day span.
Ooh, wow.
Yeah.
Wow. Yeah. That's awesome, man. Good for you. And you're stuck in a radar facility with probably no outside windows or anything else for that.
Correct.
Right.
Correct. It's a dark area. It's cold in there, and you're working crazy hours, man. So and trying to build a real estate portfolio while you're doing that is tough.
Right. But you've done it. I mean, that's the thing is you guys have done it. Tell me when, I guess, since this is so fresh for you, when did you know that, hey, I'm onto something. I can not only onto something, but I can now replace my income, or at least I have enough momentum to know that what we're doing is going to be worth the investment.
It was a combination of getting the multifamily syndications, the big ones, closing on those last year, which increased my net worth substantially enough to where I know that over the next couple of years, as those refinance and sell, I'll have a lot of income coming in that I can use. But the biggest thing was building the cash flow I needed to sustain myself. So I basically built enough cash flow through my short-term rentals and everything to where I was meeting what my take-home was from the W-2 job. And that was the point where I realized, okay, now I can step away. This will sustain me. I can count on it. And then I'm just going to go really hard on the real estate. So it was really once I knew that my long-term strategy was going to be bringing in income over the next 3 to 5 years, and then my cash flow could sustain me over that period.
Right. That makes a lot of sense. So you closed two big multifamily syndications, you got some short-term rentals, and then you said, hey, wait, there's something to the boutique hotel space. Walk us through that story.
So it started with the fact that multifamily is so competitive right now and it's so difficult to find deals. I mean, you know how it goes, underwriting 100, 200 deals, and then a couple of those might make sense to make offers on to meet your investor expectations. You might make some offers, but then they're hyper competitive. So it's tough to find the deals right now, very tough. And you have to put in a lot of time and energy and resources into networking with brokers and underwriting having someone underwriting for you full time, whatever it is. So as we kept looking for deals, underwriting, months going by, and how difficult it was, we were realizing with our short-term rentals just how insane the cash flow was on Airbnb properties, et cetera. And we had heard of other people taking down these boutique hotels. And what we liked about it is that we can get a hotel, let's say, for example, this 10 unit that we're getting on the California coast in Northern California. We close next Monday. You can find a lot of these boutique hotels that are operated by, family operated or mom and pop operated, just like a lot of the value add multifamily, with a ton of value add, a ton of inefficiencies, just all kinds of levers you could pull to increase the NOI. And you could find those with relative ease. Now, there's not as many as these boutique hotels as multifamily, but you could find some deals right off of LoopNet that make sense where you're buying at a higher cap rate. Like a 12 cap, for example, you can go in as cash flowing day one and you can drastically increase the cash flow. So we're kind of combining what we've learned in short-term rentals and Airbnbs and whatnot, and what we've learned in multifamily. And we're kind of combining the two. And now we get the benefit of all that value add on those short-term rentals and using the commercial form evaluation and cap rates, NOI. And so we just see a ton of opportunity here, and we've pivoted because we're seeing that okay, we can put all this time and energy into these assets right now where there's just loads of them with virtually no competition. And we can accomplish the same thing for our investors as we are with our multifamily investments, but with higher cash flow. And so we're basically just kind of evolving with where the market is right now and going where we see opportunity. And even more reason why is because so many cities and municipalities are either banning short-term rentals outright on single-family homes, or they are restricting them and capping how many can be and making it a lot more difficult. And you can find these boutique hotels in markets like that and target those and reduce the amount of competition on the short-term rentals.
Right. Yeah. That was going to be the question, is because if it's already a hotel, it's already a short-term rental.
Correct.
The likelihood that there's retroactive, all that stuff gets grandfathered in and/or is already zoned for that. So
exactly, if it's zoned for it, that's the big thing. Because if it's zoned as a bed and breakfast or a hotel commercial, then those rules don't apply to you. Most of the time, these regulations are just targeting single family homes. They're not targeting, for example, Airbnb. Like the regulation will read that a single family home, these are the restrictions if it wants to be a short-term rental. So you'd completely avoid the regulations.
Right. Shawn, one of the things that I think that people get mad about is the political risk in investing in a certain area, right? It's like, oh man, we go there and there's taxes or there's this or there's that. But I think it also creates market distortions. And if you're prepared to exploit those market distortions, you as an investor can benefit from those same political kind of risks that whatever are in that area. So in this case, it sounds like the ability to buy a boutique hotel is really advantageous if you're in a climate where it's like, oh, hey, short-term rentals are really getting clamped down on, right? Does that sound about right?
That is exactly right. I couldn't have said it better myself. I mean, like you said, like in San Diego, for example, they're going to severely restrict the number of Airbnbs or short-term rentals, single family in the city. They're going to cap it at 1% of the housing supply. There's all these other rules. And San Diego is just an insane market for short-term rentals. I mean, as an example, I have a duplex that grosses over $220,000 a year. One side is a 2-bedroom, the other side's a 3-bed. And a city like this, where there's going to be far less of those houses available for people to rent, you could take advantage of that if you can find a boutique hotel that makes sense.
Right.
So you're just, you're evolving with the market, you're taking what the defense has given you and making adjustments.
Right. Yeah, absolutely. What are the risks you see in moving into the boutique hotel space?
So I think that the risk in, going into a boutique hotel space is always going to be like it's a little bit different than multifamily, because when business is booming, it's booming. And, it fluctuates more, right? So there could be, like, for example, COVID really hurt the hotel industry. It hurt them bad. And then that was just an unforeseen black swan event. And things like those will affect those boutique hotels more than they would affect multifamily. Because in multifamily, like, yeah, people could maybe not afford to pay rent anymore, but they are on a lease and they owe you that money. Whereas with short-term rentals, it is a little bit different. Now, you can try and mitigate that risk in a lot of ways. And one of the things that we noticed, like Airbnb itself, that platform, that they have more market share on short-term rentals than all the major hotel companies. And these boutique hotels, you can list them on Airbnb. That's where people are increasingly looking to book. So I see that you can mitigate a lot of that risk, and you can just increase your income by putting your boutique hotel and listing it on those kinds of platforms. And that's a great way to mitigate that risk, because even in the economic downturns, people are going to Airbnb and trying to book those smaller units, buildings.
Have you seen any decline in demand on the short-term rental side?
There was a decline in demand last year a little bit. There was a dip. This year, there's been a huge increase. Even with the hotels, they've bounced back massively since this time last year. And that's, it was COVID. There was a lot of restrictions, and that's going to hurt everybody whenever you can't go out to dinner in a given city, where, like, if your boutique hotel is in Little Italy, but you can't go to any of the restaurants, it's not going to do as well.
Right. Absolutely. Talk to me about the underwriting of those. I mean, you're looking at a hotel, you're looking at buying it. It's been run, I'm assuming, by some mom and pop or, a similar operator. How do you underwrite that? How do you make projections? What are some things that you feel like our listeners should know if they're looking at this type of investment?
So it's gonna be a lot more complicated than, in some ways, than underwriting a multifamily property. The data can be a lot harder to get. Right. So, number one, if you're buying these from these small time operators, they're typically going to have really bad financials. I had one send me a Word doc with just like 2 paragraphs, and they were missing the vast majority of expenses and stuff. That you're just going to have to expect that you're going to get garbage financials. And you're going to have to work around that. You're going to have to either find somebody that's done this before and use some of their income and expense numbers to look at. We will use CoStar reports, run reports on similar nearby properties. We like to look at AirDNA data, which is a short-term rental data business. We'll combine that with the CoStar data, because you can look at short-term rentals on AirDNA that are a shared room, and find data on nearby boutique hotels that way, and what kind of revenue they're bringing in. So you got to use a lot of different sources. On the 10 unit we're buying, we even went to the nearby properties and just straight up asked the manager on site, hey, we're buying this one. We want to ask you a couple questions. And a couple of them literally opened up their books and showed us everything we wanted to know, what their revenue was, all that kind of stuff. So I think a combination of those 3 strategies, you can collect enough data to help you find average nightly rates, occupancy, and things like that to see what your baseline is, and then also what you think you can get with the renovations, and make better projections. But it takes a lot of digging, because there's so many factors with short-term rentals.
Right. Yeah. And that's it. And I think your key point there is it takes a lot of digging. It doesn't sound like there's and not that there is one central source for anything, but it sounds like this one takes a lot more just kind of craft and nuance to it than just like, hey, we're going to underwrite and look at the 5 properties around it. It's like, okay, we're going to have to build our own data table here.
Yeah, exactly. And like with like CoStar and multifamily, you could pull just about any bit of information that you want on comps.
Right.
But if you're looking at boutique hotels, a lot of those boutique hotels aren't reporting their income and information to CoStar. So like that makes it a lot more difficult. And that's why you have to do a lot more boots on the ground and investigative work. You know what I mean?
Why do you think these sellers are selling?
So the 2 sellers so the one we're closing on next week and another one we got an offer in, both sellers are similar. They're older in age and they want to retire. They've owned these properties for just a really long time. and they're ready to dump them. We've got an offering on a property with a lady once she's owned it and lived next to it, this 7-unit bed and breakfast for forever. And she's just ready to retire and doesn't want to deal with it anymore. And so we run into a lot of that. And that's really what we target, to be honest with you. We're interested in the value add properties where we don't think they're running it right and they're ready to get rid of it.
Right. Fantastic. Talk to me about the return profile. I know you had mentioned that you have a duplex there in San Diego that's just, off the charts revenue on the gross revenue side of things. How does that differ when you start getting into the boutique hotel space?
So when you get into the boutique hotel space, you're definitely looking at lower nightly rates, simply because it's not a standalone house and it's a smaller room and whatnot. But, essentially the kind of the returns, that's what you asked for. So the returns our investors are seeing and what we're projecting, we're able to, the general business plan is to go and do our value add right away, take the property offline or half of it offline at a time, go and completely renovate it inside and out, add amenities like some hot tubs, maybe some cool fire pit areas. And then after we have 12 full months of financials, so, with renovation, it'll probably take about 17 months to get a full 12-month P&L to show a bank, and then refinance and pull all of our capital back, return all the capital. And in some cases, when we're underwriting, all the investor capital plus a little more on top, and then sell in year 3 or 5. And our investors can see a 2.5x to 3x equity multiple. So really robust returns. Basically what people were seeing in multifamily 5 to 10 years ago.
Right. Yeah, absolutely. Tell me about running these. I mean, other than, platforms like Airbnb, what does the day-to-day operations look like for you guys? How are you managing that side of the business?
So it's a multi-pronged approach. What we do is we convert these into the main thing we do is convert them into a self-check-in operation, just like with an Airbnb property. Okay. And the reason is because we can reduce payroll because we don't need a manager on site to simply hand people keys or answer questions or whatever. So we can reduce that payroll drastically. And oftentimes that opens up an innkeeper room or an office that we can also make a unit. So we put the keypad locks on every single door. We'll put it on booking.com, have its own private website, listed on Airbnb and VRBO. And across all those platforms, the guest will get self-check-in instructions. We have 24/7 guest communication via virtual assistants and some full-time employees. So they'll be able to answer all the guest questions via phone call, direct message, whatever, if they have any trouble getting in. We also have, right next to the keypad lock, we put a spare key lock just in case something like that happens. And so the day-to-day operation is made much easier that way. It can all be done remotely. And then we have full-time cleaners that can handle certain tasks with us. But if there's a maintenance request that needs to be made, our 24/7 staff will be able to get that message, call a handyman, call a plumber, whatever needs to be done. So all of the management is done remotely, and it's a lot more efficient that way.
Yeah, absolutely. Yeah. So and then you guys, of course, are the backstop to that management. So there's not a third party management or anybody else coming in that's helping you run these.
Right. We do have a third party management, but it's owned by my partner, Rich. My partner, Rich Summers, has his own management company for short-term rentals, and then we use his management company. But we're able to streamline pretty much everything. I mean, we even give our cleaners, an Amazon account and multiple accounts where they can order supplies as they're going low. So that's all automatic and we don't have to do it ourselves. So automating a lot of the operations increases efficiencies, helps us have more revenue, and decreases the expenses.
Absolutely. What is a cash on cash, like on average? I know you probably can't talk deal specifics, but for a limited partner coming into a deal, what do you guys target for an acceptable cash on cash return to your investors? Because these are heavy income producers. And so I'm just curious what that looks like.
Absolutely. 15 to 20% cash on cash plus. And as the years go on and after we've repositioned it, that could increase on some of these deals. So really nice cash flow. In multifamily, it's kind of the opposite. Like you might get if you're getting 6 to 10% in cash on cash, you're doing pretty dang good. And then, obviously your investors, they make their money when you sell or refinance. They'll get a big pop when you sell, and then their average annual return IRR will look really great. And with these boutique hotels, it's kind of in the middle because you're going to get really nice cash flow and still get a good check when we sell.
Right. No, that's absolutely cool. I love the ability that you guys have found to pivot and to pivot quickly. I mean, you started off, I think you said, with two big multifamily syndications. You had some short-term rentals, and then you said, "Wait, there's an opportunity here in the boutique hotel space." And that's really, really cool. I love the kind of thought process behind it. How you guys have done your underwriting, how you've gone out to the street level, literally, to find out and make your own kind of market comps, if you will, for what these assets can produce. So that's absolutely cool. Shawn, thanks for coming on the show today. I certainly appreciate it. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
You can go to pac3capital.com. That's PAC, the number 3, capital, capital.com. And you can click on the, contact us button and fill that out. And then I'll reach out to you within 24 hours. And you can also just email me directly, Shawn at pac3capital.com, SHAWN at pac3capital.com.
Awesome. Thank you again for your time today, Shawn. I certainly appreciate it.
Absolutely. Thanks for having me.